Hello everyone, I'm Paul Robin.
And I'm Larice Brown. We're from the FDIC's Division of Depositor and Consumer Protection.
The Dodd-Frank Act addressed the many servicing problems that surfaced during the financial crisis by amending the Truth in Lending Act, or TILA, and the Real Estate Settlement Procedures Act, or RESPA. These amendments add a number of new servicing-related provisions. The CFPB implemented these amendments by writing the Mortgage Servicing Rules in Regulation Z, which implements TILA, and in Regulation X, which implements RESPA. In writing the Mortgage Servicing Rules, the CFPB stated that it sought to address the practices that led to significant consumer harm and other pervasive consumer protection problems across major segments of the mortgage servicing industry.
Thus, the servicing rules include requirements in areas such as loss mitigation, imposing specific procedural requirements that must be taken regarding borrowers seeking alternatives to foreclosure. They also include requirements on matters such as periodic statements, force-placed insurance, and escrow accounts, and specific written policies and procedures. However, small servicers are exempt from a number of these requirements.
Why is this? Well, the CFPB has explained that most small servicers are community banks and other small institutions with strong ties to their communities. Their business model depends on maintaining good relationships with customers, and so they probably are already doing many of the things that the mortgage servicing rules require, particularly regarding loss mitigation with borrowers. As we noted in the introduction to this video, after explaining the exemption, today's presentation will focus on those parts of the mortgage servicing rules that do apply to small servicers, which, to be clear, also apply generally to non-exempt servicers. In this segment, we'll focus on understanding which servicers are entitled to the small servicer exemption, including how to accurately determine whether your bank qualifies for the exemption.
So, are you a small servicer? Let's first look at the definition in the regulation itself. An entity qualifies as a small servicer if any of the following are true. 1. The entity services, together with any affiliates, 5,000 or fewer mortgage loans, and the entity or an affiliate is the creditor or assignee for all of the serviced loans. 2. The entity is a housing finance agency as defined in HUD regulations. Or 3. The entity is a nonprofit that services 5,000 or fewer mortgage loans, including any mortgage loans serviced on behalf of associated nonprofit entities, and the servicer or an associated nonprofit entity is the creditor for all of the serviced loans. The definition of small servicer is located in Regulation Z and also applies to Regulation X.
So the definition is fairly short and straightforward, but here are some points to keep in mind. First, in order for the small servicer exemption to apply, both your bank and any subservicer that your bank hires to perform servicing duties must meet the definition of a small servicer. So even if you meet the definition of a small servicer, the exemption will not apply if you hire a subservicer that does not itself meet the small servicer requirements. Second, it's also important to note that currently under the rules, to qualify for small servicer status, you must serve only your own loans for compensation. That is, if you service any mortgage loans for a fee that you or an affiliate did not originate, or that you or an affiliate do not own, your bank will not qualify as a small servicer, even if you service 5,000 or fewer loans in total. And your affiliates will also lose their small servicer status as well. Remember that an affiliate is any company that controls, is controlled by, or is under common control with another company.
So let's start with the servicing rules definition of a mortgage loan. The definition is generally the same as under Regulation Z, which is a closed-end consumer credit transaction that is secured by a dwelling. A dwelling here can be any residence, including houses, condominiums, cooperatives, manufactured homes, mobile homes, and trailers if used as a residence. And it does not matter whether the mortgage loan is also secured by the land on which the dwelling is situated. It counts either way. In other words, the mortgage loan counts either way if secured by a dwelling, but is not counted if secured only by land and not a dwelling. Note that the applicable definition of mortgage loan used to determine small servicer status for any of the exemption provisions is in the TILA and Regulation Z mortgage servicing rules and is different from the definition of a federally related mortgage loan, which is defined in RESPA and Regulation X.
Now, let's take a moment to determine what types of loans count towards that $5,000 loan limit. You must count all mortgage loans secured by a dwelling, whether a first lien or junior lien loan, except that you do not count reverse mortgages, home equity lines of credit, or timeshares. You also do not have to count loans that your bank services for a non-affiliate free of charge. That is, where your bank does not receive any compensation or fees for the servicing. These loans, sometimes called charitably serviced loans, do not count and will not affect your ability to qualify for small servicer status.
Let's look at some simple examples of how to count mortgage loans for determining eligibility. Assume you service 3,000 mortgage loans and one of your affiliates services 3,000 mortgage loans. All the loans were originated by you, all are secured by houses or condominiums, and none are reverse mortgages or timeshares. So all of these loans count, resulting in a total of 6,000 mortgage loans. Accordingly, you do not qualify as a small servicer because the total exceeds 5,000. By contrast, consider a situation where you and your affiliates together service 5,200 mortgage loans, all of which you originated. 200 of these loans are reverse mortgages. This would seem to take you over the 5,000 loan limit. However, the 200 reverse mortgages do not count. Thus, only 5,000 loans are actually counted, and you can still qualify as a small servicer. In this next example, assume you service only 4,000 loans in total, but a number of these loans were originated by a lender other than you or your affiliates, and you are paid for servicing these loans. Neither you nor any of your affiliates is a creditor or assignee for that loan. Here, you do not qualify as a small servicer even if you own the mortgage servicing rights for all of the loans, because to qualify as a small servicer, you or an affiliate must also be the creditor or assignee for all of the serviced mortgage loans.
So now that we know which loans to count, we need to know when those loans should be counted. You'll need to determine whether you qualify as a small servicer each year as of January 1st. If you meet the definition of small servicer on January 1st each year, you will retain small servicer status for that year. If on January 1st, however, your bank no longer qualifies as a small servicer, you must start complying with the mortgage servicing rules from which you were previously exempt, either 6 months from the date you ceased to qualify or the following January 1st, whichever is later. Let's look at a couple of examples. Let's say that you qualify as a small servicer on January 1st, 2015, but then the number of mortgage loans you service increases to more than 5,000 loans as of February 1st, 2015. Assuming you still service more than 5,000 loans as of January 1st, 2016, you would lose the small servicer exemption as of that date and would have to start complying with all of the applicable servicing rules requirements. In contrast, look at an example where a bank increases the number of loans it services to more than the 5,000 limit as of February 1st, 2015. But then it goes back down to servicing fewer than 5,000 loans on January 1st, 2016. In that case, the bank would still qualify as a small servicer on January 1st, 2016. And in our final example, let's say you're a small servicer and you increase your servicing above the $5,000 qualifying loan limit as of October 1st, 2015. Let's also say that you maintain that level as of January 1st, 2016. In this case, you would lose small servicer status on April 1st, 2016, which is 6 months after October 1st, 2015. Remember that the grace period lasts 6 months from the time you no longer meet the small servicer qualifications or until the next January 1st, whichever is later. Also remember, if you lose the small servicer exemption for yourself, you lose it for all of your affiliates and sub-servicers as well.
It's important to be certain about whether your bank qualifies for the small servicer exemption in order to know which provisions of the servicing rules apply to you.
If you do qualify for the small servicer exemption, you do not have to comply with many provisions of the servicing rules, but it does not mean you are exempt from all of the servicing rules provisions.
So in the next segment of this video, we'll discuss the mortgage servicing rules that apply to small servicers and briefly mention the other mortgage servicing rules.